Imagine a top-tier surgeon or corporate lawyer pulling in $500,000 a year. On paper, they are rich. But if you peek behind the curtain, their bank accounts are running on fumes, and their retirement portfolios are practically non-existent. You might think someone with an advanced degree simply never learned how to budget, but a lack of financial literacy rarely causes this kind of self-sabotage. The actual culprit is their own ego. Psychologists track the root of this behavior to a money script. These are deeply ingrained, unconscious beliefs about money that we form during childhood, and they end up driving our financial decisions for the rest of our lives. For many high earners, the dominant script is what experts call money status. It is the subconscious, intense belief that a person's net worth is directly equal to their self-worth. When you link your value as a human being to the price tag of the things you own, you develop a relentless need to look wealthy. Ironically, spending all your cash to project that image to the world becomes the exact mechanism preventing you from ever actually being wealthy. This ego trap is most dangerous in highly affluent neighborhoods. Surrounded by successful peers, there is immense invisible social pressure to constantly sustain a specific level of prestige. Economists describe this using the Veblen effect. It is the deeply irrational behavior of buying premium, overpriced goods, not because they are better or more useful, but simply because they broadcast status to your neighbors. When the family next door upgrades to a new luxury SUV or posts photos of a lavish European vacation, it triggers an immediate sense of lack. You start spending based on a dangerous illusion, comparing your complete financial reality to their highly curated and often debt-financed highlight reel. This fuels a condition known as lifestyle creep. Every time your salary goes up, your baseline spending automatically expands to consume the new income, effectively erasing the raise. Instead of routing those extra dollars into an investment portfolio or a savings account, every cent of free cash flow is drained to pay for the upgraded life. Through sheer consumer sabotage, a massive salary is completely neutralized. The wealth is destroyed in the driveway and the living room before it ever reaches the market. Feeling financially squeezed by their bloated lifestyle, these status-obsessed professionals often panic. Instead of adopting a slow, methodical approach to building wealth, they turn to the stock market for a quick fix. Here, a new cognitive blind spot kicks in: overconfidence bias. The ego convinces them that because they are highly competent in medicine or law, they possess the analytical skills to easily outsmart market averages. That arrogance leads to excessive rapid-fire trading. They rack up massive brokerage fees and take on uncalculated risks that quickly end in devastating portfolio losses. The academic field of behavioral finance has studied this exact phenomenon for decades. Pioneers like Daniel Kahneman have proven that when money is on the line, our psyches are systematically skewed by predictable cognitive biases. One of the most destructive of these biases is herd behavior. When people watch their peers supposedly getting rich on a trendy asset, the fear of missing out completely overrides any logical analysis. Driven by pure envy, they blindly emulate the crowd, pouring money into highly speculative bubbles without understanding what they are actually buying. The action cycle is catastrophic, but predictable. They buy assets when hype has pushed prices dangerously high, and then, the moment the market inevitably drops, they panic sell at the absolute bottom. By letting their ego dictate their investments, they take the greatest engine of wealth creation in history and transform it into a machine that actively destroys their net worth. We can actually calculate the exact economic weight of this behavior. By examining intertemporal utility models, we see the hidden, long-term mathematical penalty of yielding to immediate gratification. This graph illustrates the concept of opportunity cost. Every single dollar you spend to appease social envy or lose in a reckless ego-driven trade is a dollar that you have permanently robbed of decades of exponential growth. Consider the rule of 72. This simple formula calculates exactly how long it takes for your invested money to double through compounding interest. If you take the monthly payment of a status signaling car and invest it at an average market return, the math shows exactly what that money would become over 30 years. Left alone, that small sum surges upward in a massive exponential curve, But when it is drained month after month to project a wealthy lifestyle, you are left with a flat, stagnant line that barely beats inflation. The true cost of envy is not the sticker price of a luxury upgrade. It is the millions of dollars in invisible, future wealth that you sacrifice just to buy it. The counterintuitive reality of personal finance is that true wealth is actually invisible to the public. It consists of the luxury cars you did not buy, the massive home upgrades you walked away from, and the capital that is sitting quietly, compounding in broad market index funds. The psychological antidote to status seeking is a script known as money vigilance. People with this mindset prioritize saving, discretion, and ultimate financial security over any desire to flash their cash. When you explicitly decouple your emotional ego from your financial decisions, you build a firewall. You protect your portfolio from the inside out, making choices based on logic and math instead of fear and greed. True financial freedom is not achieved by attempting to beat the market, and it certainly isn't won by outspending your neighbors. It happens when you finally stop trying to impress people you don't even like and simply let time do the heavy lifting.